So welcome to the 18 chapters book already. It's almost the last one. There's one more after this, which is only 8 pages, I believe, but I'm still going to make a different video about it. It will probably be quite short. But this chapter was mainly about the market breadth, which is you take any number, it's the relative position between advancing stocks and negative and declining stocks. So of course, when you have more declining stocks, the market breadth is overall down, so to speak. So what you can see here is he took this picture out of like probably something like the newspaper or something in like the 1990s, I believe. And there's been 3,400 issues traded on that single day, on a Monday. And it's not necessarily a blue Monday, but the overall market breadth is down because, well, there's been more declines than advances, and unchanged doesn't really matter here because you're mainly looking at advances and declines. But you can still see there's actually more new highs than new lows. So that could be a strong sign, but it doesn't necessarily have to be. It's just more an observation you can make. And the closing ticks have, on this day at least, been down 135, which means whenever there's a stock and it closed on a red candle, on a red Japanese candle, or like anything lower than its previous, then relative to the starting point, it's got to be a red stick, right? So yeah, that's just to take care of. And here again is the Dow Industrials, S&P 500, Nasdaq, and the Russell. It's good to take an average of this and really get the whole American company or American stocks and all that stuff together, so you get a really good view of like what is actually happening, right? These are just a bunch of oscillators again, actually, in like some moving average, but just indicators as well. Some of them are on TradingView, but I just recorded a bunch of them on Chrome, on the web browser, so I'll just showcase them there after the video, the end of the video. But basically, TradingView them as well, but I'm just going to show them here. So basically, this is the advanced decline line, and it's basically taking all the advancing shares divided by the negative or declining shares. And of course, you can't just do this on a single stock. That's not really going to happen. So you're going to have to use like the S&P or the Russell, or like any bond that has a lot of stocks or at least multiple combined, right? So yeah, this creates a decline line, which showcases what the market is doing. Of course, in a downtrend, it's down, and in an uptrend, it's up. Yeah. So this is a market breadth indicator, and it also smooths out the difference between the number of advancing and declining issues. But basically, 0 is equal, and whatever is below the 100 is considered oversold, and whatever is over 100 is considered overbought. I'll just show it to you to get some more clearance in the end. But yeah, this is the McKellen oscillator. There's also a summation index, but I think it was like a smoother, a longer range. Oh yeah, so you take more days on average, and you can clearly see like what's happening. So this can happen from like a day's range. This could be like the start of the market or start of the market to the end of the day, and you could just take a whole bunch of stuff, and basically it's a line between these things. As that one is a smoothed line. So that's the McKellen. I'll show them in a second. This is the new high, new low, probably. Yeah, so this is the new high, new low. This is what I was talking about before, like the 52-day period of the stocks itself. And it's always better, of course, to have new highs than to have new lows. And this is just an indicator on different stocks and what the overall sort of company stocks are doing. Let me see. There's another one which is so this shows the New York Composite Index versus the NYCE Composite Index, and you can see the difference between the number of stocks hitting new highs and new lows. Yeah, not sure what to make of this. It's just there. You can use it, but it's, of course, you're not going to be able to do it with crypto. You can combine crypto, but what you've really seen with crypto is whenever Bitcoin goes up, which actually is kind of trailing behind the S&P 500, like the average company or the average market, Bitcoin goes up and everything follows Bitcoin, but just to an extreme, right? You can see every crypto is up right now, and when you see Bitcoin going down, every crypto is down, which is kind of I'm not sure if it's like, yeah, I'm not sure what. It's not like you can easily trade altcoins that way because it's not a solid strategy, but it could be something behind it. Yeah. Well, sorry. Let's get on to the video. This is the up volume and the down volume. So you can also make a indicator out of this one, which they have done. And this indicator shows the relationship between the number of stocks that increase or decrease in price and the volume associated with the stock increase in price. So, not sure if this is a single stock, but I guess when an up candle happens, you have these graphs happening. But I'll just get on it in a second. Here you can see the ARMS index, which is basically the same, also called TRIN. And whenever there's like a market high based on the ARMS index, it's most of the time a low on the New York Composite Index. And you can see oftentimes that is the truth, like right here and right here. But it doesn't necessarily mean that the lows are market highs. But you can find see the bottom line, which is easier to spot now. See the last one. Not sure what this one is again. This is a moving average of 10-day open arms. It's smoothed down, seems like. So yeah, that's probably what you can make of it, because this one isn't that clear, right? Now we have the Equivolume, which is basically like a sort of a bar chart, but when there's a lot of volume, the bar just gets extended horizontally. So you can see this was an up candle, probably, yeah, up candle because it's white, and it just had a lot of volume. But it doesn't necessarily have to mean that when there's a lot of buying power, that it has to be a lot of volume, because there could be no sellers at all, right? So you can see two candles right here of about the same height, and you can see this one had so much volume compared to the other day, which you know it is smaller, but not really relative to the width of the candle. So you can really see like what is how much volume there was on a single day. And this is basically combined with a candle power chart. So this is candlesticks with the Equivolume. I wasn't able to find it on TradingView. Maybe it's there, but I'm not really gonna use it anyway. Maybe on like some charting software, but for now it's fine, really. This is the Nasdaq and the S&P ratio. I'll just show this in a second, but basically what is happening, the Nasdaq is leading compared to the S&P ratio. So you sort of gotta see as 1-on-1 is the markets are equal to each other, and when this indicator rises, it basically meaning at this point the Nasdaq was 1.55 times more than the S&P, and at this moment is 1.81. That's basically how you got to view those things. I believe this one is the same as well. Yeah, so this one is the Dow Industrials versus the Russell, and I believe Russell's like 2,000 stocks, and Dow Industrials is more the raw material type of stuff, I believe. I'm not sure what's in there again. So yeah, I'll just start things off. I'm just going to the yeah, like any Nasdaq to S&P ratio, which I showed earlier, but basically you can sort of see the same thing as of now. So there was a time that the Nasdaq was 3 times not really value, but just relative to the S&P ratio, I guess. Yeah, so there was like a spike in 2000. I was born in 2002, so I'm not sure what happened here. Probably something, but I'm just gonna start off where I ended and work my way back. So this is the Equivolume I was talking about, but it's not really that difficult. It's just when there's a lot of volume, there's a lot of there's just a much bigger candle. But in my opinion, it's kind of ugly. I know it might be helpful, but I think it's kind of ugly. So I'm not really gonna use this one. This is the ARM index, which basically combines the, I believe it was volume and the increase and decrease in price. You can have, of course, moving average here as well. So, and I believe a great strategy was, I think he mentioned a 10-day and a 52-day. I think there was one, or 10-day and 21-day indeed, something like that. So yeah, it's not that difficult as well. I haven't really experienced this or like worked with this before, so I'm not sure really what to say of it. Then we have the new high, new low. I find this one, it could be interesting as well. Because I believe if there are is like if a stock is advancing, it of course would have probably more positive or positive candles than negative candles. So yeah, that's good if something makes new high. I think it's a healthy thing, really. And when it's slowing down, it's also a good opportunity to see. Oh, and actually, if I should explain these charts, this is don't look at this. Don't look at the bottom stuff. What's happening? So you can see the moving average of a 10-day, which is 14.9, which is a red candle, so it's probably negative. Right? And when you look at the this is for like every individual day, sort of, right? And then you have a whole bunch of stuff. So this is for the S&P, this is for the Dow, and we can look at Nasdaq as well. And you can see the average of the closing candle was 1.8, and I believe I'm not seeing any green ones. I'm not sure if it's just always red or. Oh no, sorry, there's a minus. Okay, so the average candle was positive, new high, new low. Sorry, more new highs compared to new lows. So, then we have the Maclellan summation, and this was basically a smoother version of the Maclellan oscillator. And when you look at the Maclellan oscillator, sorry, what was about it? Yeah. Oh yeah, advancing and declining stuff. So of course there will be more advancing stocks here, and this is on the S&P 500, but it doesn't necessarily have to be reflected into the chart. Let me just look for some extreme where it's just not happening at all. I guess it kind of combines with each other, but it doesn't necessarily, like, you can have 5 stocks that do like go 200% in theory. Okay, it's not likely, but you can have 5 stocks that go 200% in a single day, which will probably end up being a positive stock anyway, or a positive candle on the daily, and have all the others go into the red, which is, it's still probably gonna be red, but I guess you kind of know what I mean. This is the smoother version, which is basically a line, but you can basically still look at it the same way as you have the zero line, and these are the advancing candles, and it's basically the same. And this is the advanced decline line. Yeah, quite boring line, but I guess it gives some clear overview. Not sure, I haven't used this before, but I think that's it. So, yeah, well,